proactive tax planning and tax diversification can save you thousands of dollars in tax over your lifetime. You just need a plan. We've got that and more coming up. Welcome to another episode of the Wise Money Stories, where we're doing a deep dive into real financial planning strategies, helping to apply that to your financial life. My name is Mike Bernard. I'm your host. With me in the KFG studios, certified financial planner and CPA, Jared Moxness. Jared was just on our recent Wise Money Spotlights talking about exit planning for your business. So if you own a small business, have a side hustle, and hoping someday to turn that business into an asset that helps you with your retirement, make sure you go check that out as well. Jared was also on the Wise Money Talk Show a few weeks ago, about a month ago now, talking about all the tax planning changes with the new tax law. I'll just say that. I hate the name of these. So Jared, welcome back to the show. And as a CPA turned CFP, let me just ask you, as you introduce yourself, when did you know you wanted to be a financial planner? Not just a taxpayer or CPA, wanted to be a financial planner?
That's a good question. I honestly could tell you I probably don't really know the exact time, but there's a lot of things that led up to it. I was introduced to financial planning when I was in college, and then I listened to the radio show for, I don't know. As soon as I graduated college, my wife will tell jokes about how we would listen to it after we first got married.
Oh, you're kidding.
And so listening to the radio show, and then I became a client of the firm, and I got to see the process and see how it all worked. And it was kind of a nice translation to go from taxes into financial planning. There's obviously a lot of crossover there, and wouldn't have it any other way. Yeah.
And you certainly are made for it, Jared. You know, most folks that do taxes, we were just talking about this before we turned on the camera, that, you know, they're rule followers. And financial planners, yes, you got to follow the rules, but are more creative and advice oriented and sort of in your corner. And so yeah, it's a good blend. Tax planning is one of the 6 areas of your financial life. There's 6 areas to everyone's financial life: Jared's, mine, yours. And tax planning is one of those areas. And when you're making great financial decisions, you need to consider how those financial decisions are going to impact all of those 6 areas to bring synergy to them. So Jared, hot seat question before we get into your story: what's the difference between tax preparation and tax planning?
Yeah, it really comes down to tax preparation is more reactive. There's not a whole lot you can do when your CPA or your tax preparer sits down with your information and puts the numbers in the boxes and spits out a 1040 or a business tax return. So tax preparation is just being compliant. It's we want to get the right information to the IRS or to the state and make sure that we're compliant and paying the right amount of taxes. Tax planning is obviously much more proactive. We want to be looking forward. We want to make sure we're taking advantage of the rules as they're currently written before the end of the year. And we also want to do the planning work so that there's no surprises. Yeah. And so we're trying to be very proactive. We're still doing tax planning in the year that we might be filing for coming up next. So 2025, we're doing tax planning right now through the end of the year for a lot of folks. And so it's all about what rules can we take advantage of, and let's make sure there's no surprises.
Yep. Trying to help you pay the least amount of tax over your lifetime, if not multiple lifetimes, looking at those different strategies. And then through the context of all 6 areas of your financial life, determining, okay, which of these strategies are good, but they don't really make sense for you right now, this year, maybe we'll consider it next year. And which are the strategies that, oh my goodness, you have to, it's a no-brainer.
Yeah.
You've got to jump on this.
Right. Figuring out which tax brackets we're going to fill up. How much income we're going to choose to realize. We get to make those decisions. Some of your income is just set. If you're working a W-2 job, or you're collecting Social Security, that income, we know what that income is going to be. But there's often a lot of things that we can do to figure out, okay, are we going to realize more income this year or less income this year to help fill up some brackets and pay the least amount of taxes over our lifetime.
Okay, I don't think you intended to do that. That's a great segue into what I know of your story. I don't know all of it here, but yeah, sometimes we've got influence over the income that lands on our tax return. Other times it's outside of our control. So Jared, you got a good tax planning story here. What's your story?
Yeah, and this story isn't actually unique to just one client. You see it quite often, actually, but at a high level, when we're talking specifically maybe for high income earners where they've got disposable income that they're setting aside into 401ks and maybe IRAs or Roth IRAs, but also maybe into a taxable brokerage type of account, an account that they pay taxes on the dividends and interest and capital gains as they go along. The issue here is if we don't own the right things in those accounts, we could be creating unnecessary tax obligations. If we own things that spit out certain types of income or are just inefficient in how they're structured by the fund companies, and these things can create tax on your tax return where you don't even see the income land in your statement or land in your account.
Yeah. So go in, give us a few more details. Real life financial planning scenario.
Yeah. So we're in these instances, what we're seeing is some of the investments that are picked to be, let's say, in the taxable account or in the taxable brokerage account, they might be inefficient in a way that, hey, you're spitting out a lot of interest, or we're getting a lot of ordinary dividends, which means we're paying taxes on this income the same way we pay taxes on our wages at a higher rate. Where if we just shifted that just a little bit and we picked maybe some things that stocks or equities that we could own long-term, if we own those for more than a year, we could sell those. And instead of paying taxes at 35 or 37%, like we might on some of this other investment income, we could pay taxes at, 20%.
So we do see this all the time, the need for tax diversification, but it even goes beyond that. So yes, filling up those tax shelters, the 401k, the Roth IRA, considering things like the backdoor Roth. We'll get into that here in just a second, but also being tax sensitive in that brokerage account, that trust account, that joint account, the account that's not tax sheltered. So Jared, get into a couple of the details here.
Yeah. So you could be looking at two high income earners. Maybe they're both making a few $100,000 a year, where they're socking away, tens of thousands of dollars potentially into this brokerage account on top of what they're already doing into the tax shelters. And what that does is when that money goes into certain investments, that might create, in this case, ordinary dividends, which are taxed the same way your wages are. And so if you've got ordinary dividends, just by picking a fund that might be less efficient, somebody might have $100,000 of ordinary dividends or $50,000 of ordinary dividends. That might equate to an additional $15,000 or $20,000 of tax.
Okay, so let's just camp on that right there. So ordinary dividends, most people don't realize this. There's two different types of dividends when it comes to your taxes. When it comes to the investments, they look the exact same. But when they land on your tax return, an ordinary dividend is going to be taxed at ordinary income tax rates.
That's correct.
So if it's a couple both earning a couple $100,000, it might be in the 32% tax bracket, something like that. And,
right.
And that ordinary dividend is going to be taxed at 32%. If it's a qualified dividend, it's taxed at capital gain rates.
That's
so
correct.
In this case, instead of 32%, it'd be at 15%.
Maybe as high as 20.
Yeah. Maybe as high as 20. So for the same amount of income to pay half the tax. I mean, that really adds up if you're thinking about it every single year.
Yeah. And think about it this way. If that investment that is spitting off ordinary dividends is a good idea in your taxable account, maybe it's an even better idea inside of a tax shelter, like an IRA or a Roth IRA or a 401k or something like that, where, hey, we're still getting the goodness of the investment itself, but we're getting the tax efficiency of having it outside of that taxable brokerage account.
Yeah. And then the other thing that can be a lot of tax havoc for these non-IRA, non-tax shelters account is investments that pay capital gain distributions.
Yep.
So I know in your story that, we see that come up a lot. So talk through that.
Yeah. So at a high level, what is a capital gain distribution? Think if you're invested in a mutual fund or maybe even an ETF, mostly mutual funds though, if you're invested in one of those and those funds make money, their underlying investments make money, they can't just keep that. They have to pass that along to the investor. And so if you get those capital gain distributions, let's say you got $50,000 of capital gain distributions, congratulations, your account didn't go up by $50,000. It's just kind of restructuring the basis of what you've got going on. But you have to pay the taxes on it.
Yeah.
And so that can be kind of painful. And so figuring out a way to say, okay, what are tax efficient ways to get the same maybe market exposure? We still want to own a lot of the same things potentially, whether it's equities or international equities, whatever it is, we want to own those same things, but let's do it in the most tax efficient way possible so that we can avoid some of those potential capital gain distributions and that extra tax.
So in the situation, a couple, both high wage earners, when it comes to tax planning, looking at the tax return, identifying opportunities, and I would say, just restating what you said, Jared, there's a couple different layers to it. First is your tax diversification. So using your different tax shelters to the kind of fullest potential. So in that situation, both couples, you do want to make sure that they're maxing out their retirement plans, considering whether it should be pre-tax or it should be Roth.
Yep.
Okay. Beyond that, things like either contributions directly to a Roth IRA, or in this case, made too much, so considering a backdoor Roth. What about a mega backdoor Roth? Were they eligible for that?
Yeah, that is something that we're currently investigating, if that will be an opportunity for them with their employer. So a mega backdoor Roth, what that is you basically, after you fill up your normal contribution to your 401k, so if you're over 50 years old, you can do, a little over 30,000. And if your plan allows for it, you might be able to do up until about 70-ish thousand in after-tax contribution. So the difference between the 30 and the 70, there's about $40,000 worth of room there. What you can do is you get that money into your 401k and then get it moved right out directly into a Roth IRA, and now the growth is tax-free forever into the future. That's why we call it a mega backdoor Roth, because typically you can only get $7,000 or $8,000 into a Roth IRA each year. But in this case, if your 401k allows for it, you can get tens of thousands of dollars into a Roth IRA during the year and then let that grow tax-free.
Yep.
Huge opportunity if the plan allows for it.
So the first layer of this tax planning is tax shelter strategy, that tax diversification. But then that second is if you've got a non-tax sheltered account that you're still funding. And for a lot of people, high income earners, that makes a lot of sense. It's then being tax sensitive with your investment strategies within that account.
That's correct. So picking strategies, there's strategies out there called direct indexing, where you can track, for example, how the S&P 500 works or how the global market is tracking. You can do that by owning a handful of individual stocks or a number of individual stocks that don't spit off that same income. So you can track how the market's going to do without needing to own, that mutual fund that might create that extra income that might be unnecessary.
Direct indexing makes sense for a lot of folks. And in this scenario that you're talking about, absolutely seems like it would make sense there. Also, exchange traded funds.
Yeah, ETFs.
Right? ETFs, they have a more tax sensitive structure to them, and very few will kick out capital gain distribution, sort of pinky swear that they don't. They could, but most of them don't. So they're deemed more tax efficient that way. And then if you do have an investment that is kicking off dividends, being aware, are they kicking off qualified dividends or non-qualified dividends? And like you said, Jared, if it's an investment that you like, should you even hold it? And it's kicking off non-qualified dividends. Should you even hold it in that taxable account, or should you hold it in a different tax shelter? The whole point with all of that, though, is to point out the risks and the traps, but also the opportunities by taking a proactive look at your tax picture instead of a reactive one. Because in this situation, the reactive was looking at a tax return, jaw hits the floor. My goodness, we owe $40,000 extra tax that we were not expecting because all this income that we didn't even receive landed on our tax return.
Right. And I'll actually take the tax planning even a little bit further. So we talk about tax diversification in a taxable account or in a non-qualified brokerage type of account. Sometimes it's okay to have a little bit of tax inefficiency there because it might allow you to do more tax planning as you get closer to retirement. So for example, if you're saving into that brokerage account and you build up a decent amount of cash, when you retire, now you can make your income basically zero.
Yep.
And then you can do things like Roth conversions, or if you've got highly appreciated stock, you could sell that and potentially pay 0% on it. Now we're talking into some of the weeds of tax planning here, but the idea is that account, while we want to make sure that the investments inside of it are tax efficient, we also want to use it to do some tax planning down the road as well and buy us even more flexibility as we creep up on the doors of retirement.
Absolutely. That same non-brokerage account is also a source of tax diversification for you and can be a huge asset, especially at the beginning of retirement. All it takes is a proactive approach to your financial life and to your tax picture as well. We call that tax planning. That's one of the 6 areas of your financial plan that you got to work on with your certified financial planner. If you don't have a CFP on your team, you can contact one on our team. You can find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.